Welcome to this week's Money Metals podcast, helping gold and silver investors during these treacherous times. Now, here's this week's market wrap with commentary and analysis from the company voted 2015's Precious Metals Dealer of the Year in the U.S., Money Metals Exchange.
This is Mike Leeson with Money Metals Exchange, and it is my privilege now to be joined by Frank Holmes, CEO and Chief Investment Officer at U.S. Global Investors. Frank is a well-known market commentator and seasoned market analyst whose firm specializes in investments in the precious metals and natural resources sectors, among others. He's also the author of a book titled The Gold Watcher, Demystifying Gold Investing. Frank regularly offers his excellent market commentary at usfunds.com on his Frank Talk blog. It's a real honor to get a chance to talk to him today. Mr. Holmes, thanks for joining us.
Well, thank you for inviting me and sharing some of my thoughts with your listeners.
Well, I know you're a busy guy, and we've only got a short amount of time here, so I'll get right into it. First off, the big news this week was the FOMC meeting. Any surprises there for you? What did you make of their Wednesday announcement?
No, there really wasn't. When we look at we do these mathematical models, in which I quite often publish on my blog, and I look at the stretch. I call it the stretch, like touching your knees to touch your ankles, and the move in the dollar was so great over the past 1 month and 60 trading days and the price of gold declined, but the dollar was so strong it had to correct, and I didn't believe it was going to happen, that they were going to raise the rates. I think that they have to be very careful. Exports are going to slow down, and I think there's other factors, so I expected what took place.
You alluded to it there, but yeah, the biggest headwind facing the metals continues to be this unprecedented advance that we're seeing in the U.S. dollar as compared to the world's other unbacked currencies, of course. Do you see that coming to an end here? It sounds like you do, but will the continued issues over in the Eurozone and with the euro maybe extend that dollar rally a little further? What is your research telling you there?
Well, I don't think it's going to turn yet, because what we have to take a look at for that fear trade, which is a key component driving gold, is not just the strong dollar. One has to look under the hood at the engine. Why is the dollar strong? Well, it's not a war. It's not a fear. The dollar is strong because it has the highest real rates of return today. Now, I think in the next 2 months, we're going to see the CPI number, which went negative, turn positive, and that will put a compression on what they call the real rates of return. So for your listeners, real rates of return is a key factor that drives the fear trade for gold. And what I mean by that is that what will the government pay you for a 5-year government bond? Take away the CPI number, and you either get a positive rate of return or a negative rate of return. A year ago, we had a negative rate of return. If you bought a 5-year government bond, you were locking, losing money. Now, it was plus 168 basis points. The gold will trade inverse to that. So whenever you have, in any country, you're seeing gold in euro terms exploding on the upside because interest rates are negative there. You're seeing gold in South African terms exploding because interest rates are negative. Japan, also 52-week highs, 3-year highs. Why? Because gold, negative real interest rates. America, without lifting interest rates, has the highest interest rates.
You follow the mining sector very closely, of course, being a metals and natural resources guy. What is the state of the mining industry right now, given this prolonged period of suppressed metals prices? Are we going to see the production declines and reduced supply start to creep in? Because from a demand side, we still seem to have a significant appetite for physical gold and silver throughout the globe. So what do you think about a potential supply-demand gap existing here?
I think it'll take time, but I do believe that we're going to start seeing it shrinking, like we're seeing it just fall off a cliff in South Africa. I think it will, continue. This we've had the peak is behind us. I see how the next quarter happens, but I think the biggest thing for these stocks is they're at all-time cash flow lows. When you do a cash flow multiple, looking at what they went up to 35 times at the peak in 2007 times cash flow, and now they're single-digit numbers. So gold stocks are very attractive. But what they have to do to become even more attractive is to get the discipline of return on capital model. And that's what the airlines was plagued with. They just grew for the sake of growth, and they never had a return on capital. and they were extremely volatile and problematic. Gold stocks, same thing. They just kept acquiring assets of very high valuations and then were unable to deliver them into production. So they've gone through this sort of catharsis, which I think is very positive and constructive. I don't think you're going to see new mines coming on stream at any rapid rate for several reasons, because the shareholders won't invest if the management's not going to have a return on capital. That's why many of the big cap gold stocks have lost. The CEOs have been fired. It's a record turnover, losing their jobs. So now the new CEOs coming in, they're much more disciplined, like CFOs, of that return on capital.
You note in your book about the importance of having at least 10% of your portfolio dedicated to bullion or mining stocks. From our experience, we've found that most people, even those who recognize the importance of having at least some tangible assets in their portfolio, are significantly underweighted in the metals. In fact, the vast majority own none at all. First off, why do you think that is?
Well, the Federal Reserve doesn't keep other countries' currencies. It keeps gold. So if they don't trust other governments' currencies, they only trust gold. Should an investor? I think that's a basic thought process. Two is that the math of markets is that there will always be imbalances between the monetary and fiscal policies. So when we had gold run to $1,900, you had minus 300 basis points on a 10-year government. I mean, it was unheard of, and since then it's turned positive. That's why gold has corrected. So you will get these imbalances, and gold has these wonderful runs, and I think that having a 5% weighting in bullion and a 5% weighting in gold stocks, then the key here is to rebalance. And the reason why I share this with you and your listeners is because the DNA of volatility. The DNA of over any rolling 12-month period of bullion is about the same as the S&P 500, plus or minus 19%. It's 70% of the time gold can go up 19%, fall 19%. Same with the S&P, so it's a non-event. It's when it goes twice that rate. So when gold hit 1900, it was plus 30%, and that was time for a correction, which we've had. Now, gold stocks are a different animal. They have a plus or minus volatility of 38%. So whenever you see gold stocks down 38%, then they start becoming quite interesting. If they're down more than that, which we've had this volatility, where they fall 70%, the odds of them mean reverting, that is, rising 35%, is very, very high. So what happens is that when you have this rebalancing, you end up catching that volatility. You end up taking your profits of your stock market and your bonds, you buy a little bit of gold. Gold has a great rally, then you take the profits from there and you put it back into your bond portfolio and to your general equities. That's the magic of that rebalancing.
Do you find that the general investing public is receptive to this idea of having at least 10% weighting in gold and gold stocks? What are you finding there? Is it a tough sell now, given the last few years, or are more people opening their eyes to it, given all the issues with the currencies around the world?
Yeah, I think it's always been a challenge for mainstream to go into the gold space. I think the big play that we had leading up to 2007 was from hedge funds putting big billions of dollar bets on the GLD, and that woke up a lot of other investors. And I think that was the big trade there that took place. And they were very much on the negative rates of return. Whenever the dollar had negative real rate of return, they increased their gold exposure. The dollar starts turning positive, they decrease their gold exposure. But for that retail investor, I think that a lot of them follow moving averages. I think that if gold's above the 50-day moving average, then they get a little warm towards it. If it's above the 200-day, then they want to have exposure to it. Vice versa, when it goes below the 50-day, they become frightful and they're out. So it seems that using trend analysis and moving averages and looking at fund flows of the GLD, you can see money going in, money going out, all based on the 50-day moving average.
I would think that given the undervalued metals markets and the seemingly overvalued and maybe frothy equities markets, that now may be a great time for somebody to take you up on your investment advice to have that sort of portfolio balancing. Am I right there?
Oh, totally. I mean, I've always advocated it, and the magic is to have that 10% weighting. And if you're not going to go buy, gold coins, then you should be looking at, or a GLD, looking at buying state gold jewelry. You can get great prices. I was just in New York City, and you can basically get a very low markup, whereas if you go buy new gold jewelry, you end up paying a 400% markup. So there's lots of opportunity in that secondary market, and you can collect beautiful gold coins on these down days. And we saw last year a lot of very smart Americans were huge buyers of silver coins, and the Canadian Mint had record sales. I think they sold 27 million 1-ounce coins in the U.S.
Yeah, and the U.S. Mint, of course, set records last year once again for Silver Eagle sales as well. Yeah, silver is definitely the metal of choice among the casual investor for sure. Well, Frank, what are you looking for the remainder of the year in the gold and silver markets? Will we finally see an exhaustion of this long corrective period in the metals? And on top of that, what is it going to take to get the metals going again?
What's going to take it is the love trade. The rising GDP per capita in China and India is very important. We have huge dollar cost programs that are in China today. The World Gold Council has been extremely successful, where people put and buy a gram of gold every month, and they have I think 20 million was one number that I'd heard had signed up for this program, and it's very, very correlated with their GDP per capita. So it appears that the GDP per capita, in fact, China was a pivot point last year, surpassed the U.S. Now, their GDP as a macro number is far, far behind the U.S., but on a per-person basis, it has been growing, and we're seeing Chinese have exceptional demand. In fact, the Chinese consumed all the world's gold supply from mines last year. And then we have central banks coming in and buying. So any liquidations coming out of the GLD or any bricks of gold we're finding that are moving from the U.S., big bricks, over to Switzerland, being melted down to smaller coins, and then showing up in China, going through the Shanghai. And the Chinese have done an interesting financial district they created in Shanghai, a tax-free zone, so that they're going to become the market makers, not the what they call the price makers, not the price takers. The London Gold Exchange is moving, and I think that that's their vision. So there is a tectonic shift taking place, and it's gradual. It doesn't happen all in one event overnight. But I think that when we start seeing the rise in China and India with their GDP per capita rising faster than it was, like back when it was 2006 and 7, that growth rate, we'll see a big surge in that gold demand from that end. We're also seeing central banks. What you're not seeing and where the selling's been is predominantly people playing this negative interest rates to positive interest rates.
Do you expect the sideways action to continue here in the metals over the intermediate to long term or through the remainder of the year?
I think we'll see lots of action in the second half of this year. And the interesting part, I think gold has actually held up exceptionally well if you use the gold to oil ratio. I mean, the oil drop has been significant, and there's always been a trade of hedging oil petrodollars back into gold. I think the difference here on that big trade when it happened in the 80s is that we had 3 billion more people on Earth. Under President Reagan, when oil had such a big slide, like we just recently had, the difference is that this is showing up as a tax break around the world. The Americans' ingenuity and innovation in fracking has led for us to a big surplus, so we're so price competitive, but this drop in oil is a $500 billion tax break to emerging countries. And I think that in the second half of this year, we'll start to see that economic growth. Last point for you. Mesquite Gold Mine in California, they said that the drop in oil prices impacted them by $11 million of free cash flow. One mine. That's how much diesel they were using.
Yeah, when you look at it against the backdrop of the big oil correction here, gold has definitely held up pretty strong. It will certainly be interesting to see this all play out. Before we let you go, Frank, can you tell our listeners how they can follow your commentary and also learn more about U.S. global investors if they're interested?
Sure. Go to usfunds.com or phone 1-800-US-FUNDS, usfunds.com, and you can sign up for the Frank Talk blog and Investor Alert. We have about 40,000 readers in 180 countries. We publish every Friday night, and we do a SWOT analysis. That is, we look at the strengths and weaknesses that impacted asset classes like gold last week, and then we forecast what could be an opportunity to threat next week. And this seems to have the biggest following. It's always succinct, but it's comprehensive.
Well, yeah, I can vouch for the great content that's there, and it's been great chatting with you. We appreciate your excellent insights, and I definitely hope we can do it again in the future. Thanks very much for joining us.
Thank you for the opportunity.
Well, that will do it for this week. Thanks again to Frank Holmes, CEO of U.S. Global Investors. Check back next Friday for our next weekly Market Wrap podcast. Until then, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a great weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes for answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds. Call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by between 7 a.m. and 5:30 p.m. Mountain Time, Monday through Friday. Or you can lock in your order online 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.